Hello and welcome back. I'm Natalie MacDonald and you're joining me for today's Sydney Direct, where we look at some of the issues impacting the APAC region. The New Zealand economy, once described as a rockstar economy, but with plummeting milk prices and stagnated GDP, I caught up with Mike McCarthy of CMC Markets to see if perhaps we should be finding a new metaphor. Michael McCarthy, thank you very much for joining us once again. Always a pleasure to catch up with you.
And you, Natalie.
Okay, so today we're talking the New Zealand economy, and the first question we have to ask really is the New Zealand economy still a rock star, or do we perhaps need to be finding a new metaphor for it?
There is some evidence that the commodity-based export-driven buoyancy that we've seen in New Zealand is now dissipating, in fact coming back to the pack, and the big fall that we've seen in agricultural commodity prices means that it probably is no longer considered a rock star economy.
You touched on it a little bit there, and one of those metaphors which does sort of ring true is that the Kiwi economy has really put all of its eggs in one basket, namely dairy. We're seeing a huge price plummet within the dairy markets. How much impact is that likely to have on the Kiwi economy over the next 2-year period, really?
Well, it's already had an impact. In fact, we're seeing growth estimates revised downward from around 3.5% to closer to 3%. Some analysts going even lower than that. It's going to have a very significant impact. It makes up more than half of all of New Zealand's exports. And in that situation, naturally, the economy is going to feel the impact of those lower milk prices.
Does this form part of a bigger trend that we're seeing sort of amongst these smaller exporter countries which fared through the GFC reasonably well but are now starting to suffer? And similarly, the RBNZ cut rates for the first time in 4 years. Do they still have sort of those bullets in the barrel in order to ride this period through?
That is one of the advantages that economies like New Zealand have at the moment. They haven't cut their rates to zero. That makes them relatively attractive in return terms, but it also does give them room to move should they need to. And that action from the RBNZ last week is probably only the first step in a number of cuts to come.
And similarly, the RBNZ have continued those calls really to try and push the Kiwi dollar lower, which have been largely ignored really for the most part. Where do you see the Kiwi dollar continuing to sit through the mid to long term period?
Quite clearly, with a lower interest rate environment on the cards, there is pressure on the Kiwi. It has fallen against the US dollar, but it looks like it could fall further. And while we're sitting above 70 cents against the US at the moment, there's a real possibility that over the next 12 months, we'll see 60 cents against the US.
Mike, always a pleasure to catch up with you. Thank you so much.
Thank you, Natalie.
Our thanks, as always, to the team at CMC Markets for their comments. Don't go away, as the Dukascopy TV team will be back with plenty more exclusive interviews and FX analysis for you right here on Dukascopy TV. For now, though, it's goodbye.